All right, we're on learning objective 1.4. We are still looking at the accounting equation. Just as a quick review, assets equal liabilities plus owner's equity. Okay. Now, like any equation, it has to balance. How will it stay in balance? Well, we're looking at what they call double entry bookkeeping. Okay. For every single transaction, there is two things actually happen every single time. So if I go to Walmart, I have $50 in my pocket, and I take $50 into Walmart and I buy $50 worth of groceries, two things have happened. Okay. If I was in class giving this lecture, I sometimes try to put cash in my pocket. So I want you to imagine me pulling some cash out of my pocket. Pull cash out of my pocket, I pay for my groceries. Two things happen. I now have $50 less cash, but I have $50 in an asset in groceries. Now, obviously, I don't make journal entries when I go to Walmart. I'm not that much of an accountant. There are some people who do that, but I want you to think about it in the business context. Every time something happens, two different accounts are affected every single time. And that is what keeps this equation in balance. Now, the equation can be in balance and you still made the journal entry wrong, but if it's not balanced, we know for sure that it's not right. Okay. So we have this double entry bookkeeping. We're going to go through transaction analysis. Sometimes I tell students, if you haven't listened to anything I said up to this point, now would be a good time to listen, because if you don't get these concepts right here, you won't understand chapter 2, you won't understand chapter 3, 4, all the way to chapter 10, and you won't make it past this class. Okay. You have to learn the ABCs of accounting before you can move on to the next chapter. Okay. I do a comprehensive final. I can do a comprehensive final over just the last chapter, and it would still be comprehensive because you've got to know all these steps to get to that chapter 10. Okay. So please listen, take your time with this, because this is vital for you to pass Principles of Accounting 1, 2, and to go on to financial management. All right. So we have just a nice little example here. How do you analyze a transaction? Okay. They give us the first one: buying a computer for the office of $2,000 cash. Two things happened, right? We now have a computer, which is an asset, and we gave up $2,000, which was an asset. Okay. Just hiring an employee does not trigger a transaction. They actually like to trick you in a couple of these problems in chapters 1 and 2. And that's the way they trick you. They'll say they hired an employee and you're trying to think of how much do I make the entry for? There is no entry, because just hiring them does not trigger a transaction. Okay. All right. So we've got 9 different examples here of transaction analysis. We're going to go through them. And here we go. The first transaction, almost all of these problems you're going to be working for the next few weeks is going to be a brand new business. With a brand new business, the transaction 1 is the owner putting money into the building, or into the business, I'm sorry. So Smart Touch Learning receives $30,000 cash from the owner, Sheena Bright, and the business gave capital to her. Okay. I always try to tell students, figure out what's going on with cash first. A lot of entries involve cash, but there's a few that don't. But it's always good if you can figure out what's going on with cash. Sometimes you can reason out the other side of the transaction. Okay. So her cash is an asset. Cash went up. Now, those of you are thinking, but she doesn't have $30,000 cash now. So if you're thinking cash went down, you're thinking about her personal records. Remember, that doesn't count here. We are looking at Smart Touch Learning. We're not necessarily looking at Sheena Bright's personal finance. We are looking at this brand new business that she is starting. She's the sole proprietorship. She took $30,000 of her personal money, put it into this business. Okay. So we increased an asset, and then we also increased equity. Okay. Some students think, oh, she put money in the business, so maybe that was revenue. No, that's not revenue. She's already paid taxes on that revenue, wherever it came from. So just because she put money in the business does not trigger a tax consequence, but it does tell us she put $30,000 cash in. She now has in her equity $30,000 cash. Okay. So figure out the cash. Sometimes if you don't know what the other half, if you don't have that there showing, you can reason through the other half of that transaction. Okay. If I did a balance on my totals right here, this is very simple. We're at the first transaction. My equation would balance, right? Because I'd have 30K here and 30K there. Okay. Well, the water's fixing to get a little muddier. All right. So the next one, Smart Touch Learning, the business, purchases land for an office location, paying $20,000 in cash. Okay. They said paid cash. We know cash is going down here. Okay. Cash is going down. So I'm just going to come right up here before I just give you the entire entry. And for that $20,000 cash, what did she get? She got land. What is land? It is also an asset. So we would decrease one asset, cash, increase another asset called land. Okay. So if you notice, some students think back up here, they think, well, if you do something on this side of the equation, you have to do something over here on this side of the equation. I never said that. I just said the equation had to balance. Okay. So you can see they've added a category for land here. We are still balanced. I'm not going to do this every time, but it's easy right now to say, hey, there's 30,000 K in assets and $30,000 in equity. All right. Let's go to the next one. The next one is Smart Touch Learning buys office supplies on account is a keyword. Agreeing to pay $500 within 30 days. The liability created purchasing on account is accounts payable. So remember I told you, figure out cash. Is cash involved here? There is no cash involved in this transaction. They bought supplies. Supplies got delivered to their place of business, and they are going to pay for them later on. Okay. So cash is not affected here. Okay. What kind of asset did we get? We got supplies. Okay. So we have another category, and you could say supplies, office supplies works too. Okay. So we increased office supplies by $500, and then we increased the accounts payable. Okay. Because we owe that. Okay. I know I told you, figure out cash, figure out if cash is going up or down, or if it's not even involved. That will help you rule out what it's not. And sometimes you can guess really well and get half of it right. Okay. So I'm not going to draw it out, but you can tell we're balanced, right? If I add these up, it'd be what, 30,500 and 30,500 over here. Okay. That's transaction number 3. Okay. We are going to go through these transactions. So if you are making notes right now, which you should be as you're watching these videos, we're going to do these exact same transactions in chapter 2, and we're going to use the debit and credit rules, but that is to come. So if you're writing this down, know we're going to come back and we're going to look at it a little later again. All right. Next transaction is transaction number 4. We earn some service revenue for cash. So Smart Touch Learning earns service revenue by providing training services to clients. The business collects $5,500 revenue in cash. So what's happening to cash? We know cash is going up because they got cash. Okay. Let's look at our accounting equation real quick because I don't want you to just see the answer. Okay. We increased cash. What is the other thing that is affected? It would be our revenue. We just earned some revenue here. Sorry. We earned some revenue. So I will come down. See, this is why I can't draw these out because they keep adding and my handwriting would be all over the place here. So now you can see they added cash 5,500. Now we have this service revenue. Remember I told you if we had, I'm sorry, if we added, we're going to have expenses here in just a minute. Remember that's going to be underneath that umbrella of equity, but revenues and expenses have their own financial statement. So just because they're underneath that umbrella does not mean it's an equity account, okay? So they've added service revenue here. Equation still balances, okay? So let's move on. If the water's getting muddy, just please hang on with me, okay? All right, we have Smart Touch Learning performs service for clients who do not pay immediately. The clients promise to pay $3,000 within 1 month. The promise of the asset is accounts receivable. Remember, I told you that back up there. They didn't tell you about receivable, but I wanted to introduce that word a little sooner. Okay. So they didn't get cash. They got a promise to pay cash sometime in the future, which is an asset. So we'll increase an asset and we will increase revenue. Okay. So let's come down here. We have this new category, $3,000 for accounts receivable, and we earned revenue. Okay. We earned revenue here and we earned revenue there. One of them, we got cash for it. The other one, we got a promise to pay cash. Just because we didn't get the cash on this one does not mean we don't make the entry. We still make the entry. Okay. We will make another entry when we get the cash. Okay. That is to come. I don't think that's quite the next transaction. All right, here we go. We have transaction 6. We have payment for some expenses with cash. They said all of these were cash. So every single one of these will be cash expenses. Okay. Sorry, the 3,200 is the total. We have $2,000 in office rent and 1,200 in employee salaries. So they made a combined entry here. We have our $2,000 rent expense. Now notice we have our revenues and our expenses. Sorry about that. Remember that umbrella I told you about? All of those fall underneath that umbrella of equity, but they have their own statement. Okay. This is not my favorite because when you pay cash, you're usually writing a check. You're probably not writing a check to the same person for rent expense as you would salaries expense. I would like to see these in 2 separate entries, but we're just learning the basics right now, so it's not that big a deal, okay? We're still balanced though. We decreased our cash by the total and we decreased equity through those expenses of 2,000 and 1,200. Okay. There is a summary slide of all of these once we've done with all 9 entries. Okay. All right. So transaction 7, we have payment on the accounts payable. Smart Touch pays $300 to the store from which it purchased office supplies in transaction 3. Let's go back to transaction 3 really quick. Okay. We bought some supplies and we had $500 we put on accounts payable because we didn't pay it yet. Okay. A lot of students want to go in here and take $300 out of the supplies. That's not what we're doing. We still have the supplies. Okay. We're not, just because we're paying the cash out doesn't mean there's less supplies. Okay. So cash is going down right here. Get that to stop. Okay. Cash is going down right there. And then the accounts payable is going to go down as well by the same amount. Okay. We're just paying the bill. Okay. So do you see how it kind of doesn't make sense to go in here and subtract office supplies? We still have the office supplies. Okay. Just because we paid the bill doesn't mean we have used up the supplies yet. All right. So now we have transaction number 8. So Smart Touch Learning now collects $2,000 from the client from transaction 5. let's go back up here and I want you to look at this transaction 5 again. Remember, we provided a service of $3,000. We did not get cash. We got a promise to pay cash. Okay. Some students will tell me that I need to go in there and now that they're collecting $2,000, record more revenue. No, we've already recorded the revenue. We're not recording revenue here. We're just recording that we got the cash. Okay. So cash gets increased right there. And then we're going to decrease that accounts receivable because they paid us. Okay. So they paid us and they only owe us $1,000 after that. Okay. Do you see how my equation has kind of gotten really big now? You can see assets equal liabilities plus equity. Okay. And we could add revenues minus expenses because you can see the revenue was added right there and the expenses were subtracted. Okay. Now we're on the last transaction. Okay. This is where the owner takes $5,000 out of the business. Okay. And that is fine. That is how the owner gets paid. So cash is going to go down by $5,000. Okay. There's my cash going down to $5,000. We have a new account called Bright Withdrawals. Remember I said Bright Capital's where they put money in. Bright Withdrawals is where the owner takes money out. Okay. And my equation is still balanced. Okay. My next slide just gives us a summary of all of those entries. And here is like, I kind of equate this to a spreadsheet. We won't do it like this forever, but it does baby step us into transaction analysis. And you can see they added up all the totals that they got at the bottom and they balance. Now, this could balance and it still be wrong, okay? But you're close if these balance. You know if it doesn't balance, you did do something wrong. You have to go back. A lot of times here, maybe you recorded half of the transaction. If it doesn't balance, sometimes students might miss half of that transaction somewhere. But has to balance every single time, okay? You can actually make a mistake when you're doing this by hand. In most accounting software programs, you can't really make that mistake because it won't let you make these entries out of balance. The entry might be wrong, but it won't let you do it out of balance. It would always balance completely. Okay. All right. So we've got one more lecture after this, and we'll be done with chapter 1.